Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
On today's show, I'm talking to Marty Bergin, the president of Dunn Capital Management. Dunn Capital is one of the oldest and most successful systematic managers in the world, and Marty shares his insight on the evolution of Dunn and talks about some of the key research discoveries that has led them to stay on top of the CTA industry through the last 4 decades. For those of you who are new to the show, I just want to let you know that you can find all of the show notes, including a full transcript of today's episode, on the toptradersunplugged.com website. Now let's get started with part 1 of my conversation. I hope you will enjoy it. Marty, thank you so much for being with us today. I really appreciate it.
Thank you for having me.
Before we dive into today's more structured discussion, if you like, I just want to start out by saying that it's a really great honor for me to have you on today's podcast. It's very rare in today's world to find someone who not only has been a pioneer in the investment management industry, but who's also been so successful as Dunn Capital has been, and even more so, to find someone who can say that they've done it over a 40-year period. And if I'm not mistaken, October of this year actually marks the 40th anniversary of Bill's trading career and the 30th anniversary of the WMA program.
That's correct. I appreciate the compliment. Of course, most of that is deserved, due to Bill Dunn's efforts. And, I'm just here riding the coattails and trying to continue the success.
So today's episode is really special, and I know that our listeners will take away a lot of great insights and inspirations from what can only be described as a unique story, both on an individual basis in the sense that Bill has done something only very few in our field will achieve, but to me, it's also really unique that Bill, yourself, and your team have done it over a period of time that has seen so many changes to the industry that you're operating in, which could never have been imagined back in 1974, and which go to show that there is a great level of robustness in what you do. So perhaps a good starting point for you would be to take us back to the beginning, tell us the story about how Bill and later yourself got involved in the business, and take us through the evolution of the firm, and which I guess at its core apply technology to portfolio management.
Okay, well, I think we only have an hour, so I'll try to give the reduced version.
You take as much time as you want.
Bill, after he got his degree, he served in the military. He was actually a boot camp instructor at one point. And once he got out of the military, he used his GI Bill to go back to school and get his graduate degree. When he graduated, he went to work for the government and was working in the Washington, D.C. area as what we would call a Beltway bandit. In other words, he was working for the defense industry. And he came to the realization that there had to be a better way of making a living. So he knew that there was a way of looking at markets and using mathematical or statistical data to determine when to buy and when to sell. And his whole philosophy was based on price data. So originally he was looking at equities. And you have to remember back in the 80s, you didn't have a personal, or back in the 70s when he started this, you didn't have the personal computers. You didn't have the computing power you have today. And it became very clear that the population of equities was much too large to accumulate all the data, process the data, and then act on the data within a reasonable time frame.
Sure.
So at the time, there was only about a dozen commodity contracts being traded, and he, found futures and thought, well, this is perfect. So in the 70s, he would actually sit down with punch cards, computer punch cards. He and his son, Daniel, who is employed with us today, would punch the cards, enter all the data. They would take it down to either the library or they would rent time on a mainframe, and they would run the cards through the system to come up with the prices that they were going to execute on the next given day. And we still have a set of the punch cards that were used in the mid-70s on our wall in our conference room. So it's kind of some nostalgia.
Fantastic. Yeah.
It's an interesting period of time. And, throughout the years, the whole concept is that everything is 100% statistical. We don't use any fundamental data in decision making, and it's all purely based on price data because there's no subjective knowledge in price data. Everybody knows what the price is. We trade in highly liquid markets, so the price is being determined every minute of the day. And it's very easy to value where your positions are at any given time.
Sure. And did Bill, starting out, at the time where he started, I mean, did he know early on that he wanted to turn this into a business and not just a hobby? And I'm also curious about how you, and I know you have a completely different background, how you got curious about this and what you saw in Bill and in Dunn Capital that obviously later made you join them.
Yeah, I mean, so when Bill started out, the whole idea behind it was to make money for himself and other people. And he actually went to co-workers and friends and families to put together the first seed capital that was used for trading. Those investors, which are, in their 70s, 80s nowadays, are still with us today.
Yeah.
They've been, they joined in back then. They set up a little partnership and started trading. At the time, Bill didn't realize that anybody else was doing such things.
Okay.
If you think back in the 70s, I mean, it was before the regulatory bodies were even put in place.
Yeah. I guess I can only think of Keith Campbell around the same time doing this.
There was a few other players out there. One of Bill's very first clients was somebody that had found 2 or 3 people doing what Bill did, and they knew what Bill was doing worked. But of course, Bill didn't know what he was doing worked. And that was the first sizable investment he got. And from that point on, the rest is history.
Sure.
I think all along, Bill's idea was to find some other way to make a living besides what he was doing.
Sure.
So I think he always planned on this being his future endeavor.
Okay.
And the way I got involved was I'm a CPA by trade, and I was in Northern Virginia working for a CPA firm that just happened that one of the founding partners of the firm was Bill's next door neighbor and helped Bill set up all his accounting procedures for the partnerships when he started trading.
Yeah.
So that's how I got to know Bill. Of course, at that point, Bill had already relocated to Florida.
Sure.
I went to work there, and the first audit engagement I was on was to audit funds for Dunn Capital Management.
And when was this in time? I know you joined in 97, but when was this in time?
Oh, it was in the mid to late 80s.
Okay.
And, I was a green accountant with a couple years of experience, and I worked at that firm until I became a partner.
Okay.
And once I became a partner, Bill approached me during one summer and asked if I'd be interested in joining the firm. And my comment to him was that I had a really good thing going, so I wasn't sure that would really be the right move to make. And his response to me was, "That's fine. I'm not sure you can really handle it."
And here we are today, the president of Dunn Capital.
Yeah, I came down to visit. Of course, I already knew all the players because I had been down many times.
Yeah.
And it took me about 20 seconds to say yes.
Yeah.
Mainly because of the quality of the people I'd be working with. That's the key to Bill's success, is that we've always been a small shop. We take a lot of time and effort in picking the pieces that make up the team, and they all have to fit together, and not just from an intellectual standpoint, but also from a personality standpoint. So we have a great group of guys and gals. It's almost like a family. I mean, you work together as much as we do in such a tight-knit group. You have to have the personalities that blend.
Yeah. Yeah, no, absolutely. And you kind of took my next question by going down that route. So I appreciate that. Could you tell me, sort of, if we look at Dunn Capital today, before we jump to the next sort of area that I want to talk about. So today you run the WMA program. Could you just give us an overview of the AUM you have in that program? I know you also do other things with allocations to other programs, but I guess for today's conversation, we're going to be focusing on the WMA program.
Yeah, so we basically have two different versions of the WMA. The original WMA is geared to the risk profile that we've always targeted since the inception of the firm, which is a fairly high volatility, high return type program. And what makes us a little different than I think most of the people in the industry is we target VAR. We don't really target volatility, although once you establish your VAR, you can kind of back into what the volatility is. When I say VAR, it's basically a value at risk measure. We look at 1 month period or 22 days of trading. And when we first started, Bill he had set up the VAR as a 1% chance of losing 20% or more in a given month. And we've stuck with that throughout the years until January 2013, which we had a research project where we were trying to see if we could target the VAR according to the given market conditions. And that's a hard nut to crack.
Sure.
But we did come up with something. It's a proprietary measure of the trendiness of the markets. And currently, we change the VAR target every day based on market conditions.
Sure.
And given that, 5% of the time, we will be at what used to be the old VAR as a 1% chance of being 20% or more. Now, so our VAR has come down.
Sure.
Overall, over a long period of time. But you got to understand that's over a large period of time. The volatility is reduced from somewhere in the mid-30s to 23, 24%.
Sure.
Now, the reason we approached it that way is we didn't want to give up any of the upside profitability. And, a lot of people in this industry have reduced the volatility of their programs, but in doing so, they also reduced the upside profit. And by doing what we're doing, we can still maintain the upside profitability without, we don't give that away even though we are able to reduce our drawdowns. So it's been a significant change for us. It's only one number in the system, but I think going forward, it's going to be significant in our returns.
Sure.
The other program we offer is just an institutional version of WMA, where we basically have half the VAR.
Okay.
That's the original system.
And how much do you run in these in the combined program, you could say?
Well, so in the high volatility program, there's $300 million allocated, a little bit more than that. And in the institutional product, which we only opened up to outside investment a few months ago, it's $100 million.
Okay, fantastic. But as I said, I know you also do other things, so obviously the total firm AUM is significantly higher than this. I wanted to just sort of the next topic I just want to briefly touch upon, which I think is important for people to understand, is a little bit about how you've organized yourself as a company, because clearly things are changing in our industry, and technology allow companies to do some things in-house, some things are done outside. How have you gone about doing that? How do you do everything in-house today, or do you tend to outsource some of your functions?
So we handle everything in-house. Part of that is because it's culture of the firm. The other part of it is we really haven't found any outside providers that we would have a comfort level with, that they would do things to the standards that we would expect. Now, that makes it a little difficult sometimes because we are different than most firms. We do all our own administration. We do all our own accounting. We do all of our own, we prepare our statements. We send everything out. We do all our own trading. In this world today where people are looking for third-party administration, there's even talk now about having custodians holding the cash. I think it's a choice that people need to make. One of the things that we're able to do is things are much more timely. The investor can deal directly with us. They don't have to go to a third party to have anything done.
Sure.
The cost is significantly less because, we don't pass through any cost to the investor to provide these services. They aren't that difficult.
Yeah.
When I hear the industry or the regulators talking about forcing firms to implement some of these procedures to protect the investor, it worries me a little bit because what they're basically doing is taking the choice out of the investor's hands.
Sure.
I think the regulators should be more focused on looking for the bad actors and handling that type of activity, as opposed to putting restrictions on managers and how they do their business, which then creates a more costly environment for the investor. Our feeling has always been, as long as everything is disclosed to the investor, you let the investor make an intelligent decision based on the information they have at hand.
Absolutely. Plus the fact that at the end of the day, investors, they buy people, and if they don't trust the people, they shouldn't invest with them in the first place. And I guess a lot of this regulation and forcing people to use these external service providers, which in some cases are fine, but it does seem to concentrate a lot of the assets with a few service providers, and that in itself creates perhaps other problems that regulators haven't really thought about. But anyways, that's obviously an entirely different discussion. But before we dive into the program, I wanted to take sort of a big picture view, and I call it, talking a little bit about the track record, because a couple of things. From a general point of view, we know that the environment for these type of strategies have been somewhat different in the last 4 years. But of course, looking at your track record, you could say that perhaps you anticipated some of this, because I know that you've made sort of 3 key upgrades, if I can call it that, in the last 8 years, 2006, 2011, 2013. So perhaps you could talk a little bit about that, and what made you go in these directions, and so people have a better understanding of the track record itself, and how your program evolved from a big picture point of view.
Well, first off, there's no way we could foresee what was coming, that's for sure. I mean, I haven't found anybody that knows the future, and anybody that tells you they do, they're lying to you. So basically our research grows out of knowing that nobody has a holy grail to trading. But there are things that can be done, or we believe there are things that can be done to improve what you're doing. And as technology has advanced, it's given us the tools and the speed to do things that we weren't able to do back in the 70s, the 80s, the 90s. I also think in Dunn's case, we became somewhat complacent. Historically, we were one of the top 2 CTAs in the world with assets under management and even performance. And we went stagnant. We didn't make a lot of changes to the system for a number of years. And I think we kind of got behind. And in 2006, we had the most significant change that we had done. And that was where we moved from, it was kind of an overview of everything. We went back and just reevaluated the way we approached the markets in total. And before 2006, we looked at every market as an individual market. And we basically designed our system with a market by market basis.
Right.
We determined our trading signals, each individual market, and then we put the whole portfolio together after the fact. In 2006, we took a totally different approach. We said, nobody cares about what happens in each individual market. All we care about is what happens to the portfolio as a whole. So we started looking at the markets from a portfolio as a whole basis. And we started designing the models for the whole portfolio. And therefore, every market traded within the same model. And we even did it as far as our parameter selection process on a portfolio whole basis. That made the systems much more robust. And we also expanded from just the financial markets to, all the commodities within the WMA program, because before that, there wasn't the volume and you didn't have electronic markets. You didn't have the ability to trade real size in a lot of the commodities. But
and how many models were you actually running up until 2006?
Well, we basically had 3 models for each market.
Okay.
And they were contingency price. So we would determine, before the next day what prices would buy and sell at. And then if we hit that price, each model had its own price. We would either buy or sell during the day, given those prices.
Sure.
After the changes, we were trading, upwards of 100 different models. And what we did is we combined the models and just came up with a strength, either +1 or -1 of that market. And then we would trade on the open of each day.
Okay.
So we already knew what we wanted based on the prior day's activities.
So a lot of that expansion in terms of models was really maybe looking at different time frames within the same market to build that confidence or strength, as you call it, within a market before jumping into it.
Right. I mean, so basic trend following, you got 2 parameters. You got time and noise. So instead of just taking one time variable and one noise variable for each market, now we're looking at hundreds of time frames and noise variable. And what the other thing it gave us the ability to do was to kind of migrate between shorter term trends to longer term trends given the marketplace.
Yeah.
And, it made us a lot more adaptive. It made us a lot more flexible. And we weren't riding on single bets,
sure,
per se.
Sure.
And then I guess it was 2008, we implemented a dynamic risk where instead of targeting our risk based on some historical data, we basically started adjusting our risk every day.
Okay.
And that was a fairly significant thing we did.
Sure. And 2011 comes along, and that seems to also be a significant year for the trading system.
Well, I mean, 2008 was the real good year.
Sure.
Everybody did well. I think 2011, what was nice about it is it kind of separated us from some of the other people in the industry. If you look back from 2006 forward, what you can see as time goes is when we do make these changes in research to the program, it's been validated by the performance. Now, anytime I talk to somebody and say, hey, we got this great change, they don't know what kind of research went into it. They don't know what kind of back testing went into it. They don't know if you know what you're doing when you're doing out of sample. You can say you were out of sample, but I know a lot of people that say they were out of sample, but by the time they do the out of sample test 10,000 times, it's not out of sample anymore.
Sure.
So, we can say these things, but nobody knows for sure if we really know what we're doing. But if you go back and look at when we started making changes and look at what the performance was from that time forward, I think it's clear that, our changes have been successful changes.
Yeah, no, we'll definitely come to that, but I agree. And would you say, I mean, 11 was an interesting year certainly for you, but was because you made some changes also in 2011, if I'm not mistaken, where you introduced some additional model class or models, if you like. Is that?
Well, I think what you're referring to is when we switched to 2 algo classes.
Okay, sure, that's it.
We have an algo class that has a stop loss provision in it.
Okay.
And I use that term loosely because that is what it does, but it's not a stop loss like most people would think in terms of price movement loss. It's not based on price. So yeah, we have 2 different types of algos that they do have some correlation, but not real tightly correlated. And the 2 of them together definitely provide better performance than either one of them standing on their own.
Yeah.
That was implemented in that time period. We also added the meats to our portfolio at that point. That's a significant change because of, you go from 1 model class to 2. That's significant. But from a performance standpoint, I don't know really how significant it was. 2011 was a good year for us. There's no question.
Sure.
Especially when it compares to our peers. But, you brought up earlier about the last 4 years, and I mean, it's been a tough market for trend following. It's been a tough market for us. We were at a new high in December of 2012, but being at a new high versus a significant growth over that 5 years, it hasn't been significant. Yeah, we were at a new high, but it wasn't significant.
No.
It's not like we've done in the past.
Sure.
It's been a struggle. I think it's been a struggle for everybody.
Yeah, I mean, I'd like to certainly circle back on that and ask you a little bit about that, because I think that is an important period to recognize. But before I do that, I'd love to just finish the circle, because you mentioned earlier that a significant change or improvement came about in early 2013 with regards to, without limiting the upside, you managed to find things that could reduce the downside.
Right. So that's what we call the adaptive risk profile. And when I was explaining it before, is now instead of targeting the same VAR every single day and adjusting according to that target, we now adjust the VAR that we're targeting every single day. Mm-hmm. And basically we're looking at the market volatilities and the correlations. That kind of is what we're using as size positions. But when we look at the what we call the ARP, or adaptive risk profile, what we're looking at is whether it's a good environment for trend following or not. Yeah. And the better the environment, the higher the targeting mechanism is, the lower that we determine the trendiness of the market to be, the lower we adjust our target.
Sure.
And as an example, currently, we're trading at a bar of about 14. And like I said, when we're at the top, we're trading at a bar of 20, and we should get there about 5% of the time going forward.
Yeah.
This would be a reduced trending market.
And that number, is that derived from looking at all the markets in the portfolio and measuring the trend strength by market and aggregating that into a number, or how sort of, philosophically would you?
Yeah, basically we're looking at three things. We're looking at, each market, whether it's determined that it's trending or not, and then the correlation of that to other markets and the volatility of that given market.
Okay. And you also, you mentioned you expanded the number of markets, back in 2006. How many markets do you actually trade now?
53 markets.
Okay. So that stayed relatively stable in the last, since that changed.
we added the meats, and we dropped OJ out. And basically we look for three different things. We want a market that's traded on a regulated exchange.
Yeah.
We're looking for markets that have high volume, consistent volume over time.
Yeah.
And we're looking for markets that are uncorrelated to what our current portfolio is.
Sure.
So if it can give us diversification, it can be traded with low risk, and the viability of being able to get out of the position when needed. If all three of those things are aligned, then we can add that market to the portfolio.
Sure. And the 53 markets, they cover then all sectors, so you're sort of fully diversified. I guess that's, compared to many of the large managers where they seem to be more concentrated in financials, I guess you are fully diversified over all the sectors.
Oh yeah. So we got 23% allocation just to agricultures.
Yeah. Wow.
I think what happens with a lot of the big traders is we only have a 13% allocation to currencies.
Yeah.
And I think the larger managers are forced to trade more and more in the currency markets because that's the biggest market in the world.
Sure.
So,
but I mean, in a sense, it goes back to the point you were raising before, where you were starting to talk about the last 4 or 5 years. And, in a sense, so I'd love to hear your opinion about it. And that is, has the last 4 or 5 years been all about sector weights, meaning that the people who have been overweight in equities tend to have done much better than the people who are fully diversified, with you maybe be the exception to that rule because you are diversified and you have done well?
Yeah, I think especially in this year and last year, probably the last 3 years, if you were overweight long equities, you had an advantage over most of the other players.
Yeah.
I will say that in 2013, which we had a very good year, we made over 30%. Those profits were generated in the financial markets.
Okay.
For the most part.
Yeah.
2011, people look at us and say, "Oh, well, you must have made all your money in agriculture because everybody else had a tough year." Actually, no, that's not when we made our money.
Yeah.
So it's not sector allocation. I mean, sector allocation allows us to take on a little more risk sometimes because we have a more diversified type portfolio. But we're truly doing something different, and I don't know exactly what it is we're doing differently because I have no idea how other people's systems are operating.
Sure.
All I know is what we're doing, and I know that the correlation in the last several years has been dipping.
Yeah.
Between us and other trend followers. But I can assure you, we're still doing 100% trend following.
Yes, I mean, this is obviously the interesting bit because a lot of people have kind of diverted away from trend following. So, when doing trend following, you said you have sort of two algos groups. Just again, ballpark, how are they different? I mean, is there anything? For example, I'm just using this as an example. Some people, use moving averages as a way of identifying, trends. Some people use price breakout channels. I mean, is that the kind of difference from an overall, design point of view? Just looking at the algos.
Well, so I mean, let's just look at what happens, and that would, I can show you the difference of the two pretty clearly. I mean, one of the original algo, which was something Bill designed in, the 70s, we still trade the original system.
Okay.
That system is always in the market. Mm-hmm. It's either long or short. It's never out. Okay. It's a full reversal program. The other algo is an algo that is either long, short, or flat.
Okay.
The second algo also has, like I said, a function in it that acts as a stop loss function.
Right. So that's really the difference between those two algos. The entry and exit points, they're different, but, everybody's is different. And do the algorithms rely on a feed of sort of intraday data, or are they just sort of end of day data reliant?
We're purely looking at high, lows, and close.
Okay. And when, you talked about sort of position sizing and adjustments and trend strength determining, how convinced the models are. How does that work? Because that implies, I guess, that you would, maybe not every day, but that you would adjust your positions once you're in a trade, that it's not a static position size.
Right. So at the end of every day, we determine what position we want to be in given the data. We look at the positions we're currently in, and then we have a small threshold so that we're not buying one lot, selling one lot, sure. Buying one lot, selling one lot. And we adjust every day.
Interesting. And so, so you mentioned you have the two models, and in terms of other performance drivers in your system, would you say that time horizon or system design, meaning your algos being very different from others, is there any of that you think that plays a role in the performance, which clearly has been superior to many of your peers?
I'm convinced it's risk management and portfolio development.
Okay.
I find it hard to believe that the actual algos in trend following are really that much different than what everybody else is doing.
Yeah.
But I could be wrong.
No, I think there's certainly a lot of things to be said about, if you can identify the markets that are trending and getting a full position, so to speak, in those markets, at the same time not having a full positions in the market that are stuck in ranges. I do think that has a significant impact on performance, and that in a sense is very much sort of the holy grail of what we're all trying to do.
Yeah, the only thing is you got to be careful. So I agree with you, and I think the key there is...
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.